The buy-to-let market in the UK has faced numerous changes in recent years. These have mainly stemmed from new legislation to protect tenants and changes to how landlords are taxed, which have dented profitability for some investors and created uncertainty for the sector. And naturally, this has sparked debate about the viability of buy-to-let as an investment strategy going forwards. But despite these challenges, we haven't seen a mass sell-off of buy-to-let properties. In fact, the share of homes sold by a landlord has fallen across Great Britain from 16% in 2022 to 13% in 2024. Instead, landlords are adapting by setting up limited companies and injecting more cash into their portfolios to reduce their debt burden and protect their baseline profit. And given that it will become a little bit harder for landlords to evict problem tenants in the future, they'll likely become less willing to take a risk on anyone without those gold standard finances and may turn to insurance to protect them from the risk of default. For many investors, rental growth has been the saving grace. Over the past 5 years, we've seen average rents in Great Britain increase by 34% or £348 a month, outpacing both inflation and house price growth. And this has boosted yields to a record high of 7.1%, which has helped many landlords balance the books in the face of higher mortgage and maintenance costs. But despite this, there's been limited appetite for new landlords to enter the market. Entry costs, predominantly stamp duty, have risen, and the regulatory landscape has become more complex. And over the last few years, savings rates of over 5% for leaving cash in the bank have looked particularly appealing. But with more interest rate cuts on the horizon, that may start to change.